this week's market update, one-off rate hike or the start of a new tightening cycle? The tech stock rally, is it 1999 all over again? And what does Philip Hammond have in store for next month's budget? The Bank of England is poised to raise interest rates on Thursday for the first time in more than 10 years. If it delivers a quarter-point rate hike, and the odds on it doing so are put at more than 80%, then it will be the first act of monetary tightening since July 2007. That was when interest rates rose to 5.75%. A decade without an interest rate rise is not unprecedented, but it is pretty unusual. The last time the cost of borrowing was unchanged for so long was in the wake of the Great Depression and during the Second World War. When rates tumbled in the wake of the financial crisis to a 300-year low, no one predicted that they would still be close to zero 8 years later. It's the most tangible sign of the damage caused to the UK economy by the credit crunch. What's less clear is whether this week's likely rate hike will mark the start of a return to more normal interest rates. The arguments for and against increasing the cost of borrowing remain finely balanced. There are good reasons to think that the reversal of last year's post-Brexit cut from 0.5% to 0.25% might not be followed by any further tightening for quite some time to come. While the UK economy fared better in the wake of the EU referendum than many people feared it would, growth has taken a turn for the worse more recently. Having been the fastest growing G7 country ahead of the Brexit vote, Britain is now the slowest growing leading industrialised nation. Growth is half that in the US and slower even than in Italy, until recently viewed as the sick man of Europe. So, why might rates rise this week? Well, the principal driver is inflation, which hit 3% last month, a full 1 percentage point higher than the Bank of England's target. The bank's main monetary policy goal is to control prices, although it has been prepared to allow inflation to rise above target before, if it's confident that the increase is temporary. And that is the view of many economists. They see inflation as principally a consequence of the pound's post-referendum weakness rather than a reflection of any underlying strength, let alone overheating in the economy. As such, price rises might be expected to fall back again as annual comparisons turn more favourable. The second reason to raise rates is to provide the bank with some firepower if the economy turns down again in future. The problem with rates close to zero is that there is no room to lower them if the economy needs further stimulus. The final reason to expect a move this week is the bank's credibility. Having warmed us up for a rate rise, Governor Mark Carney risks looking indecisive if he fails to follow through with a hike. And he has form here, having guided the market to a hike in the past and then failed to deliver. The reasons not to expect much further tightening are related to the weakness in the economy and, in particular, a lack of wage growth. We've seen a string of poor economic data recently, including poor car sales figures and evidence of a weakening in the housing market. Perhaps most importantly, average earnings continue to lag inflation. In real terms, we're no better off than we were in 2006, despite the economy having grown in per capita terms. Workers are just not seeing the benefit. The outlook remains extremely uncertain too. The stalling of the Brexit negotiations and growing evidence that companies are reassessing their location strategy and investment plans ahead of Britain leaving the EU mean growth could stay subpar for some time to come. So, the chances are that we will get a rate hike on Thursday, but don't expect many more over the next year or so, perhaps none at all. Now, the domestic economic outlook might be gloomy, but you'd never know it from the performance of the stock market, which continues to go from strength to strength pretty much around the world. In the US, the main drivers have been a batch of better than expected technology earnings reports and growing expectations that Congress might be getting closer to delivering President Trump's promised tax reforms. Big tech's profits are growing much faster than investors had forecast, with positive earnings surprises feeding through into sharply higher share prices in the past few days. Amazon rose by more than 8% on the back of a 34% rise in sales in the 3 months to September. Google owner Alphabet rose 4% after a 24% sales increase, and Microsoft was nearly 7% higher, taking its market capitalisation above the record it reached during the dot-com bubble. Just like 18 years ago, tech stocks are driving the market higher and they're sucking funds into the US market. In the past 3 weeks, more than $14 billion poured into US stocks as investors decided that better earnings justify the historically high valuation multiples for US stocks. Wall Street is continuing to hit record highs, with last week seeing the 49th record close in 2017. The US benchmark S&P 500 index has now gone for nearly a year without recording even a 5% correction. This is the longest such streak since before the 1929 stock market crash. A key difference between the dot-com bubble time and now, however, is the fact that share prices are being driven higher on the back of improving earnings rather than simply the expectation of future profits. So, yes, this is a stock market rally driven by booming tech stocks, but it's not necessarily a rerun of the 1999 tech stock bubble. As well as tech profits, investors are focused on the prospect of significant tax reform. A year on from the election of Donald Trump, the promise of tax cuts finally appears to be moving closer to fruition. Having galvanised markets in the weeks after last November's election, the passage of legislation through Congress is once again pushing markets higher. That's good if tax cuts are actually delivered, but it does raise the risk, highlighted by Treasury Secretary Steven Mnuchin recently, that a failure to pass the reforms could see the markets give up a portion of their recent gains. The Trump administration has proposed a cut in the basic rate of corporation tax from 35% to 20%, a significant reduction that, all other things being equal, would leave more profits for companies to either reinvest in their businesses or to hand back to shareholders in the form of dividends or share buybacks. All of these would be good news for share prices, which is why the market has front-run the changes. Other possible reforms include measures to enable companies to repatriate earnings which are currently stashed overseas to avoid America's uncompetitive tax rate. Again, bringing that money home could boost investment or returns to shareholders. Tax is on the agenda on this side of the Atlantic too, although the last thing that Chancellor Philip Hammond will be thinking about ahead of next month's budget is cutting taxes. His problem is rather that he doesn't have enough tax revenue to cover his desired spending. And as a report from the Institute for Fiscal Studies said this week, he finds himself as a consequence between a rock and a hard place. The IFS says Mr. Hammond faces a choice between abandoning the government's fiscal targets on one hand and ignoring the growing clamour to loosen the public spending purse strings on the other. And that's all against a backdrop of a slowing economy. In particular, lower productivity growth is expected to push up forecasts of public sector borrowing. That makes his stated aim of eliminating government borrowing by the mid-2020s look ever more fanciful. The problem is that sticking with this goal means a continuation of austerity, for which 7 years on there is increasingly little appetite. Back in the markets, another milestone was reached this week for oil. It rose above $60 a barrel for the first time in more than 2 years. Breaking out of its recent trading range below that level is the latest sign that the market is tightening after a 3-year supply glut. Just since the summer, Brent crude has risen by 35% from the year's low of $45 a barrel, and it now stands more than twice its level in early 2016 when the price fell below $30. Oil has been boosted by strong demand as the global economy picks up pace in a coordinated uptick. And meanwhile, OPEC's coordinated cuts in output have helped to offset extra supply from US shale fields. It's thought that de facto OPEC leader Saudi Arabia has targeted $60 a barrel oil. In currencies, the main focus of attention in the past week has been the euro, which has been hit by concerns about the ongoing crisis in Catalonia and by the announcement from the ECB that it will extend its bond buying scheme until at least September 2018. Even though it will reduce the rate of purchases to 30 billion euros a month, the extended duration of European QE means that Europe is falling out of sync with US and perhaps British tightening. Euro weakness, it fell by nearly 2% against the dollar in just a couple of days last week, has given a boost to Europe's exporters, and the Euro First 300 index was up by nearly 1% last week. That was beaten only by Japan among the major markets, which rose by 2.6% to record a 7th successive weekly advance and a new 21-year high in the wake of Shinzo Abe's victory in Japan's recent election. His victory has given fresh impetus to his 5-year-old Abenomics programme, emboldening him to call for a 3% private sector pay rise to finally kickstart the Japanese economy after decades in the doldrums since the 1980s boom.